monochrome Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider monochrome.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us here at ausbiz. Let's check what happened overnight. Global stocks rallying, bond yields falling on data showing US producer prices increased less than expected last month, boosting expectations of interest rate cuts. The major indices on Wall Street closing near a 2-week high, with investors now awaiting a read on consumer prices. They'll be out tomorrow. Shares of AI-orientated firms Nvidia, Supermicro Computer and Dell extended a recovery from a recent sell-off, with Barclays upgrading its rating on Dell to equal weight from underweight, saying much of the AI hype has been washed out of the stock price. Starbucks was the best performer on the S&P as it jumped to its biggest one-day gain ever. That's after the coffee giant appointed Chipotle head Brian Niccol as chairman and CEO, which sent Chipotle shares lower. Home Depot reversed losses as the home improvement chain forecast a decline in annual profit and a bigger drop in its annual comparable sales. And BuzzFeed shares surged after the media company narrowed its net loss in the second quarter to $6.5 million from $22.5 million a year earlier. Well, US producer prices increased a less than expected 0.1% in July, as a rise in the cost of goods was tempered by cheaper services, indicating that inflation continues to moderate. Excluding the volatile food and energy components, core PPI rising 2.4% from a year ago. And Atlanta Fed Reserve President Raphael Bostic has said he's looking for a little more data before supporting a cut to interest rates, saying we want to be absolutely sure. It would be really bad if we started cutting rates and then had to turn around and raise them again. Well, on the release of that PPI data, the yield on the US 10-year note fell to 3.85% and the 2-year was down 7 basis points to 3.94%. And the US dollar softened against the yen and other major currencies. The Aussie is at 66.4 US cents. All right, let's get across what we're seeing on global markets with a particular focus on the US. Elfreda Jonker is joining us from Alphinity. Elfreda, good to catch up with you again.
Good morning, Andrew.
What just happened over the past week? Of course, volatility very much back.
Yes.
Is it likely to continue though? Because of course we did see the dramatic sell-off. A lot of that's been recovered though. So where are we at the moment?
It's been a very interesting rough ride, as you say, and I do think that clearly there was a bit of an overreaction to some of the negative data prints that came out, causing a bit of concerns on economic growth, like the US ISM manufacturing print and then obviously the labour print. But I think it was also a combination of some fundamental but also some technical, with the yen carry trade unwind being one of them. I do think that sort of overreaction has largely sort of recovered as people and investors continue to focus back on fundamentals and what's actually driving returns, and also a number of subsequent sort of macro data prints that's come out, like I think another labour print and then yesterday's PPI print, as we've just heard. All of those are pointing to an environment that is probably more likely to be a soft landing environment, and then also with inflation under control. So I think we are at the point now where the market is okay, we can breathe, we're probably getting closer to the Fed cutting rates again. And what this means for the equity markets, let's go back to where are we seeing the growth? And that is sort of, I think the important thing at the moment is just stick to your process, stick to those sort of company fundamentals, and don't get sort of pulled in with all the other external macro shocks and sort of consensus sort of hysteria that's been driving markets.
Yeah, well, that's easier said than done, isn't it? When you can obviously be so emotional in terms of investing. So, Elfreda, where are you seeing that growth then? Given we've just come out of very much at the end of reporting season out of the States, what did you make of that, and which sectors are looking most promising at this point?
Yes, I think if you there's been a lot of sort of nervousness around this quarter, and obviously there's a lot of nervousness around the AI beneficiaries, and are they actually spending too much relative to what they can make from AI? But if you take a step back and you just look at the actual US reporting season at the moment, you have definitely seen still some good growth coming through. So that Mag 6 that's already reported, 39% earnings growth versus the rest of the market. If you look overall, that's come out at around 11% currently. So that still implies a lot of good growth in the market. If you look underneath that and on a sector level, what we have seen is quite a bit of a switch from the more cyclical, growthy stocks that's really been benefiting and driving a lot of the earnings revisions to some of the more defensive sectors. So you have seen, for example, healthcare starting to get positive earnings revisions again. You're starting to see some of the defensive sectors getting positive earnings revisions. So I think the way we read this is that the recent sell-off has definitely created some new buying opportunities, but we have been reducing that sort of very much AI growth exposure over the last few months. We've been adding a bit of cyclical, but also adding a bit of defensives. So for example, one of those is Coca Cola, for example, that's again reported fantastic results. And I guess, as you've mentioned, if we go into an environment for the remainder of the year that's due to be volatile, given the backdrop of US elections and geopolitical risks, you definitely want to have a bit more of a balanced portfolio. And that is where something like a Coca Cola will really help a portfolio with some of those defensive characteristics of continued growth, despite the underlying volatility in the market.
So what are you seeing then with the stock like Coca Cola? Also said you're holding Costco as well.
Yes.
In fact, we're going to get retail sales data out later this week
Yes.
In the US, which arguably could be more important than the inflation data we're seeing, because we know inflation is in a downward
Yes.
trend. But that's going to be a good pulse as to how the US consumer is coping at the moment.
Yes, I think there's definitely been a variety of sort of data prints that's come out and also results. So there definitely are certain pockets that's a bit weaker. If you look at something like an Airbnb, for example, that's come out quite weak. Starbucks, besides yesterday's rally with the new CEO, that's been relatively weak. Some of the athleisure, like a Nike, but a lot of that's also been company specific. So if you look at the underlying strength of the consumer, we are not very, very concerned that the consumer is busy falling apart here. But what we are focused on is probably more on that consumer staple side, like a Costco and a Coke, relative to going very overweight the consumer discretionary names at this point in time. So I think if you look at luxury, for example, that's another area that's really been hit quite hard in this last reporting season. So we are pretty much neutral, preference for the more defensive names in that consumer, and hopefully we will get that interest rate cut that the market's now expecting from the Fed in September, and with that probably see a bit of a sort of sigh of relief from consumers that's been holding back despite relatively strong balance sheets still, and then hopefully we will see a bit of a recovery in that spending into the end of the year as that interest rate pressures start to subside.
Were there any particular results you're impressed with and perhaps has prompted you to buy the stock?
Yes, so a number of the companies that we currently do own actually came through with fantastic results, and the standout for us has been the industrial sector, interestingly enough, but very important, it's all about end markets for industrials at the moment. So some of the areas that's still quite strong, like the aerospace, Parker Hannifin is one example, HVAC, Train Technologies was another standout that came through, electrification, data centers. Those trends are actually still really strong. On the negative side, you don't really want to be in the agricultural side. Industrial automation is still relatively weak, as well as mining. So for us, we are still happy with those companies that we are in the industrial space, but it just made us feel, okay, we are still on track, we're still in the right space. So we're not really adding there, but where we have added is in a company like ASML on the technology side, that was sort of one of those AI beneficiaries that really got sold off aggressively despite a very strong result. So that prompted us to add more But if you look at just the AI beneficiaries in general, we have been reducing that just given the overall valuation that's run up of late. So I think at this point in time, we remain convicted that a number of those general AI beneficiaries, Microsoft, Nvidia, Alphabet, are still strong fundamental stories, but we also want to balance that with some of these industrials, as I've mentioned, and then some of these defensive names such as a Costco and a Coca Cola.
So you said you have reduced exposure to those AI
Yes.
names then, but which ones are you still in at the moment then?
So we are still in Nvidia.
Yep.
We do think that the underlying read-through from the capital spending that we've heard from some of the major hyperscalers and big spenders continue to support that. And there's also been a lot of talk around Blackwell supply constraints and people being very concerned around that. We think that is a sort of a shorter term impact. So the longer term trend is definitely still there, but I think it is important to note that they're not as cheap as they used to be, despite this recent sort of fallback and then rally again. So we continue to like that. We continue to like Microsoft as a beneficiary of not just the infrastructure side of the AI spending trend, but also that sort of end software side. We also still have Alphabet, and then obviously also some of these AI beneficiaries that's sitting a little bit further removed, ASML, as I've mentioned, and then on the industrial side, Train Technologies, and then some of companies like Aquanta, for example, that we have in our Global Sustainable Fund that's more focused on the energy supply into data centers. We still like those. But I do think that it is important to acknowledge that a lot of these stocks have run hard. We are focusing on those where we can actually see and touch the earnings that they are currently generating out of AI. Sort of cloud business, for example, still quite strong for the likes of a Microsoft. So that's keeping us there. But I do think the recent sort of concerns around, we've overspent, that probably for us is a little bit overdone. We still think you need to be selectively exposed and think back to the internet phase where it really took 2-3 years for the really big applications to come through, like Amazon and Google at that point in time, really to benefit. And we're only not even 2 years into the AI sort of trend. So people need to just have a bit of, I think, patience.
Patience, always the virtue when you're investing.
Yes.
Elfreda, thanks so much for joining us from Alphinity.
Pleasure, thank you.
All right, a quick check of where we're likely to open when we get going in just a couple of minutes' time. SPY futures there indicating positive, up some 0.75%. Stay with us, the open is just around the corner.